Okay, let's just dive right in. So, picture this. It's 2026. Gold is the talk of the town, absolutely smashing records, and there's a total frenzy going on. It feels like everyone is piling in. But there's one legendary investor, maybe the most successful ever, who's just sitting on the sidelines. Today, we're going to break down the Buffett standard and figure out why he still thinks gold is a pretty silly investment. I mean, just look at that number, $4,000 an ounce. Gold has completely rocketed past its all-time highs. And with all the worries about inflation and, global uncertainty, people are just rushing to what they see as the ultimate safe haven. They're stacking up bars and coins like there's no tomorrow. The hype is definitely real. And that brings us to the big question, the real mystery of this whole explainer. If buying gold is such an obvious move, why is the single most watched investor on the planet not playing the game? And this isn't just some small disagreement, This is a clash of fundamental philosophies about how wealth is really built. Now, the he we're talking about is, of course, Warren Buffett. And to really get his argument against gold, you first have to understand the man himself and the principles that have guided him for, over 70 years now. These numbers, they just scream consistency. He's 95 years old with a net worth over $140 billion, and his core strategy hasn't really changed. Through his company, Berkshire Hathaway, he's just crushed the market for decades, and not by chasing fads, but by doing something really simple, buying and holding pieces of wonderful businesses, like Coca-Cola and Apple. When this guy talks, Wall Street listens, period. Okay, so this is the absolute key. It all comes down to this one core concept, productive assets. So what's a productive asset? It's something that makes you money while you sleep. A farm, right? It grows crops that you can sell. An apartment building collects rent every month. A business creates products and generates cash. This idea is the lens. It's the filter through which Buffett views every single investment opportunity. All right, now let's see how this one core idea builds into his incredibly powerful case against gold. We'll call this round one, the Oracle's argument. This is just classic Buffett. With that little bit of folksy humor, he perfectly captures what he sees as the complete absurdity of gold. Think about it. We spend enormous amounts of energy and money to dig it up, only to then lock it away in another hole in the ground, a vault, where it just sits there costing us money for storage and security. Like he says, an alien watching us from Mars would be totally baffled. And that right there is the central pillar of his entire argument. A bar of gold doesn't do anything. It doesn't produce a thing. It won't pay you rent. It doesn't create a new iPhone. It doesn't generate any earnings. The only way you make money on it is by hoping that someday someone else will be more excited or maybe more scared and will pay you more for it than you did. And this is how he illustrates the opportunity cost. It's brilliant. Back in 2011, Buffett laid out this incredible thought experiment. He said, look, for the price of all the world's gold, you could buy all the farmland in the United States, plus about 16 Apple Incs today. So on one side, you have a giant shiny cube of metal that does nothing. And on the other, you have assets that will produce trillions upon trillions of dollars in value for decades to come. For him, the choice is, it's a no-brainer. That farmland, it's going to produce countless harvests. Those companies, they're going to innovate, they're going to grow, they're going to pay out dividends. But an ounce of gold, 100 years from now, it's still just going to be an ounce of gold. It can't multiply, it can't compound. It just sits there. Okay, but let's be fair here. Gold has been on an incredible run, and investors aren't buying it for no reason. So let's flip the coin and look at the other side of the argument. Welcome to round two, the case for gold in 2026. And, the arguments are pretty compelling. With government debt soaring and inflation still being a real concern, a lot of people see gold as the ultimate hedge. It's chaos insurance. When fear is high, investors run to gold. And it's not just individuals. We're talking central banks around the world buying it by the ton. The proponents will tell you it's a timeless store of value that has outlasted every single currency in history. And look, you just can't ignore its recent performance. Gold surged over 60% in 2025 alone. Now, some people will point to Berkshire's tiny, short-lived investment in a gold miner back in 2020 as proof that deep down Buffett gets it. But let's be real. It was a minuscule position, probably made by one of his deputies, and they sold it super quickly. It wasn't some big change in his core philosophy. So you've heard both sides of the debate. Team Buffett, Team Gold. What does all this actually mean for you, for the everyday person who's just trying to build real long-term wealth? All right, let's get into the smart money move. So first, it's really helpful to understand that in Buffett's mind, gold has a twin brother, Bitcoin, and he dislikes both of them for the exact same reason. Yeah, one's a physical element, the other's digital code, but neither one actually produces anything. Their value is entirely 100% dependent on someone else coming along later and paying more for it. And in his book, that isn't investing, that's speculation. So a Buffett-inspired game plan is actually pretty simple, but it's powerful. Number one, focus the vast majority of your money on productive assets, things like a low-cost S&P 500 index fund. Number two, if you are worried about inflation or chaos, you can treat gold like insurance, not like a primary investment. Just keep it to a small slice of your portfolio. And number three, probably the most important, avoid the hype. Don't chase assets just because the price is going parabolic. We all remember what happened with the crypto crash in 2022. Bubbles, they eventually pop. And this is basically what that insurance approach looks like in practice. See that? The engine of your wealth building is that massive 95% chunk in productive assets that grow and generate cash. The tiny 5% in gold is just there to maybe soften the blow during a crisis. It's a defensive play, not an offensive one. So in the end, it all comes back to this one simple, powerful idea. Chasing shiny objects can be really tempting, especially when fear is in the air. But according to Buffett's time-tested philosophy, lasting wealth isn't found in things that just sparkle. It's built on the solid foundation of things that actually produce. So, I've got to ask, where do you land here in 2026? Are you on Team Buffett, betting on the long-term productive power of great businesses? Or are you on Team Gold, hedging your bets against an uncertain future? It's a huge question, and it's one every single investor has to answer for themselves.